Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times bestselling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and I'm joined today by my friend Cullen Roche, who's the founder of Discipline Funds, a financial planning-driven ETF firm focused on aligning investment portfolios with real-world time horizons rather than market predictions. He's the author of a number of fantastic books, one of which we're going to talk about today. He's done Understanding the Monetary System, Pragmatic, Capitalism, and most recently, Your Perfect Portfolio. He is one of the most down-to-earth, simultaneously down-to-earth and brilliant explainers of all things financial on social media, and I'm glad to know him. Welcome to the show.
Hey, Dan. How are you doing? It's
Good.
Great to be here.
Good, man. Good. So you got a new book out. I want to break it down a little bit today, and in the new book, you argue that there is no perfect portfolio and you worry more about process. At what point did you decide to become a fun hater, sir?
Well, it's interesting, because being the owner of my own advisory firm, I wear a lot of different hats. And so I've always had to traverse both the financial planning aspects of all of this, as well as the portfolio management process. And it's really almost like a conflict of interest in some ways, because when you're navigating the investment management side of all of this, I think you're always looking for the optimal strategy. You're looking for something that is sort of, especially from a practitioner's perspective, you're really looking for something that is very easy to implement as a business practice. So you're looking for like one strategy or one framework that you can kind of just plug and play to make the business really streamlined and easy. And what you find working from the planning side is that everyone's financial plan is different. All the people are different. The families are different. The needs are different. The expenses are different. There are different time horizons in their life. And so financial planning, by necessity, requires a lot of customization, a lot of personalization. And that doesn't mean that you can just take some cookie-cutter portfolio and plug and play it into a financial plan and expect it to work. And so the main gist of the book really is that everyone's different, and everyone's perfect portfolio is going to be different for them. And you've got to sort of find what works for you. And that's really what the journey of the book is. The whole goal of the book is to basically sort of study and analyze a whole lot of different strategies and investing processes with the goal of really helping people sort of begin to pin down the different strategies and processes that might work for them so that they can arrive at something that they ultimately find will mesh well with their financial plan and their needs and their behavior, rather than just constantly buying into what the asset management business is really good at, which is just selling things that sound sort of fanciful, that oftentimes just end up being really high fee products that in a lot of cases will not only create conflicts, but not even perform nearly as well as they claim.
So that is entirely too middle of the road and sensible for it to have made any money, right? So when we think about this, I think a lot of asset managers are selling silver bullets, right? How do we begin to move our clientele from this search for a silver bullet and stop thinking about investment portfolios as products or silver bullets and start to think of them in a more bespoke way and in more systematic ways?
I mean, well, gosh, now you're going to make me start selling my own frameworks, because I've become a big adherent of what I call asset liability matching. And it really, there are just an extraordinary number of conflicts between the way that a financial planner thinks of the world and the way that an asset manager thinks of the world. And the main one being that, I mean, if you ever walked into a financial planner's office, that financial planner will never or should never tell you that beating the market, for instance, is a goal for your financial plan. They're going to try to go through your budget and your estate plan and all of these, sort of life needs over different time horizons. And then they'll try to sort of map out a way that, hey, how do we know that you're going to be able to spend the money on the things that you want to in life? They're not going to say, let's just try to beat the market and take as much risk as possible, or try to generate the optimal risk-adjusted return for the portfolio as a whole. They're going to say that, you've got college funding needs, and you've got, maybe you want to buy a car in a few years, or you need to buy a house in a few years. And they're going to try to help you actually achieve those goals, rather than just putting together a big mishmash of assets that says, hey, we think this thing's going to perform well on a risk-adjusted basis. And that's the problem with a lot of asset management, is that the asset management business works entirely from optimizing the asset side of the business, of the balance sheet, whereas good financial planning really works from optimizing the liability side and making the assets actually work in tandem with the liabilities of the balance sheet to meet the goals and needs of the investor. And so it's really hard. I mean, I think that there are lots of different strategies that people can use across different parts of their portfolio and different frameworks. And for me, I do think it's kind of a mixed bag of different strategies. Like, I ultimately, in one of the last chapters of the book, I talk about the strategy that we utilize, which is called defined duration investing. And it's an asset liability matching process, because I work from a financial planning process. I'll quantify liabilities for somebody, and then we're trying to really match the assets that correspond to very specific time horizons. And one of the messages of the book that I sort of conclude with is that if you implement something like that, you can actually take a lot of the different strategies in the book and implement them to match certain time horizons, where, for instance, maybe you have a big cash component that is matched to a down payment on a home, and there's a strategy in the book called T-bill and chill. Maybe T-bill and chill is applied completely to the house down payment component. Whereas, if you've got 30 years of maybe multi-generational and retirement needs, well, there's a different strategy called the 100% stock portfolio in the book. And maybe that's matched to that time horizon and that need. And then there's lots of different strategies that are sort of in between. And so, you've got to find the ones that match your actual financial plan and match your specific personalized needs. And that'll ultimately end up helping you sort of customize a perfect portfolio for yourself.
So let's talk about this. I think that this is one of your most important and one of your most seminal ideas, this idea of matching assets to future liabilities, not just chasing returns. Why is that a prudent way to invest, do you think? And then why is it difficult from a behavioral perspective, why is it that shift difficult for investors to internalize and grok sometimes?
Well, this idea is not new. It's not something that I created by any means. It's in the institutional world, we call it liability-driven investing. And this is essentially what pensions and banks do. The first time I came across it was after the financial crisis, right after I had written Understanding the Modern Monetary System. And I was writing about a lot of the big Fed policies, and I'm interacting with a lot of bankers who are managing fixed income portfolios. And I'm learning about how they really are doing an asset liability matching process with the way that they're very time sensitive. They can't end up being Silicon Valley Bank, because if you own way too much in long duration bonds and you have a lot of short-term outflows, well, you have an asset liability mismatch. And it was interesting at this time, because I kind of realized I'm working with a bunch of retail investors, and during the financial crisis, everything is very scary. And you start to realize that every investor who undergoes any sort of behavioral sort of hurdle, they're realizing that they have an asset liability mismatch. And typically that means that when the stock market gets really scary, what you're realizing is that the stock market is this very long duration instrument. It generates its returns consistently over very long time horizons, and it's very unpredictable in the short term. And when people sell into a downturn, what they're basically doing is they're selling the uncertainty of a long duration asset to obtain the certainty of a short-term instrument, typically cash. And so the cash gives them certainty of what the principal value is going to do. And by doing that, by selling into a bear market, you resolve your asset liability mismatch. Basically, you get the certainty you need to create short-term certainty to be able to live your life the way you want to. And we know oftentimes that's a disaster, but every retail investor has that same problem. And when you're overly aggressive and you enter a bear market and then you find yourself feeling the need to sell stocks, it typically means that you have a significant mismatch that's creating a behavioral hurdle for yourself. And so I think the nut that I'm currently trying to crack is sort of bringing this concept of asset liability matching to the retail investor in a more sort of friendly and easily implementable way. Because the problem with retail investors is that, unlike a pension fund or insurance company, you can't just run, a big actuarial analysis and say, that, hey, we have this huge pool of people who are going to need a certain amount of withdrawal from the portfolio over a consistent time horizon like a pension fund has. That makes the liability quantification very, not simple, but it makes it much more structured over specific time horizons. And personalized financial planning is a lot more difficult. We don't really know what are our liabilities going to look like in 30 years? What are your expenses going to look like even 10 years down the line? And I think that for me, what I've sort of found that's really useful is, well, you don't have to get the long-term stuff right. You can sort of vaguely match long-term assets to stocks, not knowing exactly what stocks are going to do or what your expenses are going to do. But what I've found is that when you get the short-term stuff right, it actually takes care of a lot of the long stuff, because what you do is your real risks exist in the short term, the more predictable time horizons. The 0 to sort of 5 year time horizon is what I've found. When you really drill down into that time horizon and you quantify your liabilities and expenses over those time horizons, and then you start to match what they are, whether it is, whether you're 5 years out from retirement and you kind of know what the window looks like there, or whether you're looking to, put $100,000 down for a down payment on a home, you've got kids going to college in 5 years. A lot of these short-term liabilities and expenses are things that they're very predictable, actually. And you can inflation adjust and you can dial in the numbers pretty cleanly to map out to that. And then you can match the instruments very cleanly, whether it's, you're using bonds, you're using maybe bond funds. You can even, there's even, defined target or defined maturity bond funds now, things like this that, make a lot of that short-term matching a very clean and relatively simple process for the most part. But it's a living process also. And you have to, this is something that has to be updated every year in a good financial planning process. And so, I don't even think of the idea of predicting 30-year, forecasts or whatever, to me, is not really a problem, because it's not a process in which you have to actually predict the 30 years with precision. You are really, what you're doing is every year you're making an update to that 30-year prediction. So it turns into 30 years of 1 year predictions, basically, is what you're really doing. And it's a living process. And that's what good financial planning is. But I think the reason why I think this sort of concept has not arrived in mass at the retail level is because, frankly, I think that is just too damn lucrative to sell the high fee sort of allure of, hey, we're going to generate the optimal type of return inside of a very high return generating product, and you're going to pay us 1 or 2% per year for that. And we all kind of know at this point that more often than not is pie in the sky. It's something that, the SPIVA scorecards show us that over 20-year rolling periods, 95% of active investors will underperform a corresponding benchmark. And so we kind of know that is the norm, and yet it's still prevalent, mainly because I think the incentive structure still hasn't changed for the asset managers to actually change to a component where it is something more practical. Of course, the vanguards of the world are sort of, they're making their mark, and they're, and a lot of people are catching on to the narrative. But it's still, the high fee active world is still really the dominant practice for the vast majority of asset managers.
So I'm actually living this right now. I'm going to keep it vague to protect the guilty, but I'm actually living this with someone I'm close to right now. who has come to me. The bulk of their money is well diversified with a financial advisor. They took out $10,000 or $15,000 and invested it in a way that literally their buddy told them to, which was heavy semiconductor stocks. And they're like, look, my advisor's given me whatever percent. My semi stocks are up 40% in a week. Why am I paying this guy 1% when this other thing's giving me 40% in a week? And I mean, I think on 3 different occasions, trying to take different tacks each time, I've tried to explain to them, the relationship between risk and reward, the need for diversification, the behavioral aspects of it, thinking long-term, all this. And all this friend of mine can see is that number. And all they can see is I am paying someone good money to underperform what I could be doing with little to no help. So it is just this hard problem of getting people out of that return mindset and that product mindset. I have a behavioral hammer, so I see little behavioral nails everywhere. I wonder if there's not some framing or mental accounting sort of emotional play to be had here as we match assets and liabilities. It seems like there could be something there.
Oh, I think that's, it's interesting. Some people might think of this as sort of a brother or sister to like a bucketing strategy to some degree, which it kind of is. I mean, when you're matching assets and liabilities, it turns into lots of buckets in my view. But one of the main criticisms of bucketing strategies is that people say it's just a mental accounting process where a total return strategy will perform similarly. And I say, sure, I think that's a great strength. If you can create mental accounting that creates a more behaviorally robust asset allocation, in my view, that's not a negative. That's a huge strength. And it's one of the things that I really see when I implement this sort of a strategy with people, where when you put together, for instance, let's just say a total return strategy that looks something like a 60-40 portfolio, I think a lot of people look at that and they know that the portfolio is diversified for whatever reason. Maybe it's tilted to like a certain couple of factors like value or momentum, or, maybe it's tilted to some technology or AI or whatever you think is the fun theme of the week or the year. But in total, I think a lot of people will look at that portfolio, and even though they understand the general characteristics are good, that maybe it's got relatively low fees, it's diversified across stocks and bonds, the factor tilting is something that is very fundamentally and empirically supported. That's all well and good. But when people look at that, I think for the most part, they have no idea how any of those things actually correspond to a financial plan. They look at it and they say, okay, I have no idea how a value fund is actually helping me achieve specific financial goals. Whereas when you take something that maybe even looks similar, let's say it's the 60-40, but the 40% component is broken down into its very specific time-weighted components, where maybe 10% of that is an emergency fund, maybe 10% of it is a house down payment, maybe 5% of it is pegged to a car purchase. When you actually are matching the assets to very specific goals, you are creating what is essentially some form of mental accounting, but it's goals-based mental accounting, where the financial plan and the liabilities are driving why you own the things you own. And in doing so, I think this alleviates a lot of the concerns over the total return approach, where when you're implementing something that's just a broad 60-40, the investor is not judging that against a benchmark of performance necessarily, because the financial plan now has very specific goals. The benchmark for what I would call the defined duration approach is that do you have the money to buy the house when you need to buy the house? Do you have the money to buy the car when you need to buy the car? And that becomes the benchmark. It becomes a much more planning-based goals framework where there's some mental accounting, but really it is goals-based, where you're actually supplying the liability or the asset to match a certain expense in the future, so that the benchmark transforms from, you're not being judged on the 60-40 versus the performance of like the Vanguard Balanced Index or something, or the S&P 500. The goal and the benchmark really is, do we have the money when we need the money to do the things in life that we want to do, basically?
Yeah. Every critique of bucketing on the basis of it being irrational or, similar to a total return fund, I don't disagree. I get that money's fungible, but human attention's not fungible. We're going to mentally account. We're going to benchmark to goals. And so you might as well be thoughtful and take that on in an intentional way rather than just letting it happen to you. I want to talk about your ideas around diversification. I think when, the layperson thinks about diversification, they think of it as owning just more stuff, owning more assets. Your framework is a little different. You talk about diversification as economic exposure across regimes. Do most diversified, quote unquote, diversified portfolios fail your test of diversification?
Well, I think that I don't want to say that they fail. I think that oftentimes they end up being what I would call like a homogeneous set of portfolios where there's not a series of different time horizons that are being solved for. Primarily there is one time horizon that's being attempted to solve for. So for instance, the most classic example is just looking at any sort of active stock picking strategy where what an active stock picker is really trying to do by generating an optimized sort of risk-adjusted return inside of a stock portfolio is they're taking a 100% stock allocation and they're trying to smooth the return in such a way where the return is high in the same way that stocks generate high returns, but that the volatility is also so smooth that it almost looks more like a money market fund. And this really creates sort of like a contradiction of like time horizons where the stock market is this inherently long duration instrument in my framework and my mentality. And something like cash is inherently, it's an overnight instrument in essence. That's why it generates, super stable returns and also lower returns. And when you try to turn the stock market into something that generates a very, very smooth and predictable return, it's almost like trying to turn water into wine. It's just something that, unless you're secretly Jesus or something, you're not doing that. So it's impossible, basically, is really the message from it. And yet you see this day in and day out where we constantly are talking about and cherry picking the people who, even on a statistical basis, have done this to some degree. The Warren Buffetts of the world have, generated such fantastic sort of, high returns with low relative risks that it looks like they're turning water into wine to some degree. But in my mind, that's the sort of typical example of what people are trying to do when they're hyper-focused on risk-adjusted returns. They're trying to turn a long-duration instrument into a short-duration instrument. And it doesn't work because you just fundamentally, everybody who goes through an environment like a 2008 or a COVID-like environment, you realize that stocks have inherently very risky characteristics. And I don't care how good of an asset manager you are, if you're running a long-only stock picking strategy, you're going to have big drawdowns at times. Warren Buffett has them, every good active investor does who's relying on a stock picking strategy. But the point is that you run into this situation where a lot of these strategies, they end up really having only one time horizon. And that is if you're focused entirely on stocks, you have the time horizon of an aggregate stock portfolio, which tends to be it can vary in specific time, but on average, it will end up being a multi-decade type of portfolio where even the Warren Buffetts will have relatively long drawdowns especially in inflation adjusted terms at points in their lives. And so I think that a lot of these portfolios end up looking like they have one time horizon, and again, that doesn't make them useless. It just means that I think that when you're looking at these different types of strategies, you have to understand, or it's really useful to understand the different time horizons over which they're likely to do certain things. So a T-bill and chill portfolio, for instance, is going to generate very predictable short-term returns. It will generate terrible long-term inflation-adjusted returns on average, whereas something like the 100% stock portfolio, or what I call the the global financial asset portfolio, any factor investing portfolio, those types of portfolios in the long run, they're likely to generate high inflation adjusted returns, but they're going to go through periods where they're very, very unpredictable. And this is part of why diversification works, is because what you're doing when you diversify different styles and strategies is you're diversifying, you're sort of blending the time horizons to some degree, which can create its own problem in the sense that, let's say you take, going back to 60-40, when you mix the 60 and the 40 together, what you do is you create this sort of intermediate time horizon. In my framework, it's a 60-40 portfolio actually is something that on average historically has looked more like probably like a 10 to 15 year instrument. So if you go out and you buy something like the Vanguard Balanced Index, you don't actually own an instrument that is necessarily long-term or short-term. You've blended the two time horizons. And what that means is that from a planning perspective, you probably need other time horizons. You need satellite components to actually complement that portfolio, where maybe the 60-40 is solving that sort of intermediate time horizon, but you probably need a T-bill and chill portfolio to complement that. You probably want some, maybe it's factor tilting or a global financial asset portfolio or global stock portfolio, whatever it might be. But you need complements. And in doing so, you not only diversify across lots of assets, from a financial planning perspective, you've diversified very specifically across lots of different time horizons to solve the different needs that you're going to encounter across different points in your lifetime.
So, my last question, you and I have both written about the futility of forecasting. So this isn't that. But I think a lot of people are worried about, valuations. Things seem a little bit frothy. And with those worries comes the worry of, the next bad market. When will that be? What will that look like? Again, from that behavioral framework, if someone does the things that you're talking about here in your book, if they do the things that you've talked about today, they adopt your framework, what would they likely end up doing differently during a period of market stress compared to the average investor?
Well, this is actually the main thing that I've found really interesting about implementing a sort of defined duration or asset liability matching process in real life, is that when you actually quantify the liabilities and then match the assets up front. So especially when you create a lot of certainty in that 0 to 5 year time horizon, it frees up a huge amount of behavioral bandwidth for people, where when you go through and you show somebody that, hey, we've got 3 years of emergency funds set aside, we've got your house down payment set aside, we've got your car down payment set aside, the kids are funded for college in 4 years or 5 years, then you've matched all that to safe assets, and you show that person, hey, you could ride through a 3 or 4 year bear market and it's not going to transform or change any of your capabilities to meet the goals that you have in the short term. And what that does is it frees up a lot of behavioral bandwidth to actually take a lot more risk. And it primarily what it does is it allows you to look at the stock components of your portfolio and say, you know what? I'm not concerned about what the stock market is doing inside of a 1 month or 1 year or even maybe a 1 decade period, because I know that we've structured the portfolio in such a way that our near-term goals and liabilities are covered. They're covered even for a bad scenario. And it's interesting. I've actually found that compared to the more traditional framework, which is a framework, by the way, that I used to always use. I would go through a very subjective risk profiling process and then slap together probably something that looked roughly like an age and bonds rule, or, typically like something that's a 60-40 portfolio for the most part. But what this process does, I found is very different, is that when you go through and you actually quantify the short-term liabilities and whatnot, you find that the client actually can take more risk than they thought. Because when you go through and you structure this portfolio, maybe you find that, say, 30% of the portfolio covers all of those 0 to 5 year liabilities, for instance. Well, you can then communicate to the client, well, hey, you know what? Actually, 70% of our assets can be riskier assets. They can be longer duration because you don't need any of this stuff to fund anything in the next 5 years. And therefore, we're not going to be 60-40. You don't need 40% bonds and safe instruments in your portfolio. You really only need 30. And that allows you to take more risk, probably generate higher returns, because you've gone through this very structured, liability-driven quantification of what the assets actually need to look like to match the liabilities that are actually based on the financial plan you've constructed.
Yeah, I love that. And I've seen it in practice. Cullen, thank you for joining us again today. If you're not following Cullen online, he is a voice of humor, moderation, wisdom, and centeredness in an age that lacks all of those things. So where can folks follow you? Where can they get the book? Let's sell some books, man.
You can find me on Twitter at Cullen Roche. Just one word, my full name. The book is Your Perfect Portfolio. And if you like reading, my boring asset liability matching diatribes, you can find me at Discipline Funds, where I write a blog every few weeks or so called typically 3 Things I Think on the Discipline Alerts page on the website. But I've created, the AI world is awesome because it's allowed me to sort of not only systematically create a lot of these processes for my own business, but I've created a huge number of free tools and stuff on the website too some of them are unique to my framework and the whole time-weighted process, but they're all free. They're all out there for anyone to consume. I love hearing from readers and whatnot. So if you ever want to shoot me a note, it's Cullen Roche at disciplinefunds.com. I love to hear from people. So hit me up if you want to get long, boring emails from me in person.
There you have it. An invitation too good to pass up. Go bury yourself in that treasure trove of dorky ideas. Cullen, thank you for joining me on the show, man.
Thanks, Daniel. It was great talking with you.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.